Hey everyone, I am in my car and I am talking with Nick Genovese of George Mason Mortgage. Today we're going to be going over the cost of waiting when buying a property, especially during this current market that we're in, and a couple other things on interest rates, general stuff. Whoops. On interest rates and how markets are affected. When they go down, interest rates tend to go up, and talk about some historical data on that front, and maybe some programs that might be beneficial for home buying. So, Nick, starting off, what's going on, man? How's business going? How's everything been? What have you been seeing?
Business has been good. Interest rates are definitely on the rise right now. It's been an ongoing thing as the Fed continues to hike rates. Um, we're expecting another rate hike of 75 basis point this upcoming September meeting on the 21st. So be ready for that. We're hoping that we'll start seeing some good reactions to it. The whole point of it is to combat inflation. Inflation is very high right now. Once inflation does start to move its way down, we can hope that hopefully interest rates will follow suit. Hopefully, as the Fed has somewhat tried to quote unquote promise, they're hoping that they can have a soft landing, because when interest rates do fall, you see prices fall. When prices fall, that might mean the stock market's going to come down with it. Hopefully, they can deliver that soft landing, though, and kind of keep us from going into too deep of a recessionary time. We definitely do expect a recession in the near future, so that's something to look out for and be aware of. As of right now, though, no one's set off the alarm in the media. The media has been a little bit uh, hesitant, if you will, on on the current numbers that we're seeing, such as like GDP. Past two quarters have been negative. Back in the day, that was 100% a what the exact factor that they looked at in order to say we are currently in a recession. But as of right now, things are moving along. Unemployment is still at pre-pandemic lows, which is really great to hear. Hopefully, it can stick around there. But we're just going to have to keep monitoring it, as we will likely see a lot of change in the near future.
So historically, what does a harder recession usually mean for the market? Because I mean, as you know, my age group, millennials, talk about like, oh, we're waiting for the housing market to crash. What does that typically do with the Fed? What does the Fed do? What are the normal industry reactions that happen, and what sort of safeguards are put into place that we should be aware of if we were to hit a harder recession?
Right. So in recessionary times, typically what you can see is you will see layoffs. Obviously, you can expect unemployment to kind of increase from there as costs will increase. Some businesses might not be doing as well. They might not be able to handle the amount of employees that they had originally, or that they had before the recession really started to hit. And we started to see those numbers go hand in hand with what we're actually seeing. So you can expect that, and when that happens, you kind of start to see the economy slow down. The economy is already pretty slow, which is why it's kind of odd that we haven't seen the media jump on the fact that we are currently in a recession. I think the unemployment's doing a very good job of holding that up as of right now. In terms of the markets, right? One thing that we have seen in most, if not all, past recessions is a good housing market. A lot of people have seen and will compare a future and current recession possibly to the housing market crash, which caused a huge recession, as we all possibly know. Given that, I do not think it's a good comparison, given the fact that the recession came along based on uh, bad lending and or predatory lending, if you will. There were some things that were done back then that put people into homes that they possibly couldn't afford. Nowadays, we have guidelines and regulations that follow that. And given the current economy right now, the housing market is not the reasoning behind a recession. In fact, we can expect that prices will likely do well based on past data. I'm looking right at a national house price index right now, based off of all past recessions except for two. Housing prices increased and stayed steady. Also, given our area, which I imagine we're reaching out to mostly when it comes to the media in the DC, Maryland, Virginia area, you can always expect that home prices will likely appreciate and or be stable, given the fact that we have a lot of relocation in the area. There are a lot of other factors, and one would be the Fortune 500 companies that are coming to this area, and just the innovation coming around the whole entire DMV. You can kind of see and expect that home prices will likely stay where they are and or increase in the near future. But even with a little bit of a decrease, you're likely going to not be able to time the market too well.
So
What have
what?
you been seeing in terms of housing prices? I know that the bid over ask has slowly dissipated. Whether it's all gone, I wouldn't say, just because there are certain neighborhoods that are always going to do very well based on location. But what have you really seen?
So it's interesting because I mean, we're not seeing crazy fast appreciation that we were seeing last year, which is good. We don't need that. It's not healthy. It's not sustainable. But we're seeing deceleration, which is fine. We're not seeing 10 to 15. We're seeing maybe 3 to 5, or even a smaller dip, which people assume is the housing market going down. But I think we're taking those inflated prices and they're now kind of working their way towards what they should really be at. So if a home is at like 700, um, in a neighborhood that was traditionally 650, you might see it land at like 685 or something. So like it feels like you're getting a deal, and statistically it may look like you're getting one, but in reality it's just prices are now correcting to where they should have been before we hit that like 2.25, 2.5% interest rate that shot everything out of whack. So and then it also, which is interesting, is affecting affordability, which in my opinion is a subjective term per area, and I think people's expectations of what they want in a house. So I was listening to this team. It's her name. It's the DJ Lindsay team, and they sold $1 billion in real estate in Florida, and they sold 3,000 homes last year. They're projected to do it this year, and they're saying affordability is subjective because if you can afford 500,000, that's $500,000. It's just a lot of people's circumstances change. Maybe they moved in with their parents, or maybe they had like a really nice apartment and they want that in terms of buying, but it might be at a higher price. So it's like, oh, well, the things I want is not affordable. So quote unquote, housing is not affordable, when really, and the National Association of Realtors came out that 98.5% of mortgages are affordable. So I think it's just figuring out what are you willing to sacrifice if becoming a homeowner, because usually your first home is not going to be your last home, and what is in your realm of possibilities. So which brings me actually to the big thing. What we're talking about is right now interest rates are closer to 6%, higher sixes at a 30-year fixed. What would be, what the conversation is, the cost of waiting per se? What would it be like if I was like, hey, maybe interest rates will go down to 4.5% next year. I'm looking to wait. Maybe that'll give me a better chance of being able to afford more. What would that look like in, say, the Northern Virginia area, where the average purchase price is what, 625 to 650, in DC 750? What data is there to show that it's either a sound investment to wait, or it's actually detrimental to your purchasing power to wait?
Yeah, definitely 100%. Again, timing the market, one, as some people may be a little bit more familiar with in terms of, let's say, the stock market. Um, I want to say it was Warren Buffett that had said at one time that if you miss, there's a certain amount of days. If you were to miss this, I don't know. I'm not going to quote it properly, but there's a certain amount of days where if you were to miss in the market within the next 10 years, it could take away a very substantial amount of your return, right? In real estate, you can almost think of it closely like that, given the fact that in this area, you typically see home appreciation. And also, we don't know exactly when interest rates are going to be down, right? That's one thing that you really need to keep in mind. If either of us knew exactly where interest rates would be in 1 year, then we would not need a job right now. We would simply be set for life if we could tell you exactly where interest rates were going to be. With that, with home price appreciation, I've done one little calculation of, if you were to wait a year and interest rates had gone up just a bit, chances are your monthly payment difference is going to be close to $100. If you were to wait 6 months, it would probably be around $50 to $60 in the difference, and that's higher. Given the fact that home price appreciation, you might be paying a little bit more for the home, interest rates might increase, right? And even if you wait, let's say a year and a half and your interest rates are lower, your monthly payment is likely, not always, but likely still going to be higher based off of the higher price that you're going to be paying for your home, right? So if you're looking at 500 right now at a 5.875% interest rate, then there's a good chance that when you're looking at it for 525 or 530 or 540 in a year and a half to 2 years and interest rates are in the fours, four and a halfs, you might still only be breaking even, and or you might be still paying a little bit more than you were expecting. Let alone you have to factor in the amortization that you would have gained based off of paying down your mortgage. And also you have to figure out the appreciation behind it, right? Because home price appreciation on average, let's say it's in the low single digits, right? Around 3%. And let's say you have a $500,000 home and I won't even compound it. That's $15,000 per year, right? You wait 3 years, that's $545,000 in worth without the compound, right? That's just a flat $15,000 of appreciation per year. So something you really need to figure out in terms of, you know, you're waiting, but you might not be waiting for the proper reasons. A big quote that we've been seeing all over the market right now is, you know, it is marry the home and date the rate. There will always be time for you to refinance down the road. Interest rates will likely follow suit and eventually coming back down. And again, that home might not be there in a year and a half, but interest rates might be lower in a year and a half, right? So it's just something to keep in mind. Remember that you're buying a home, you're not buying an interest rate. Interest rates are not the end all be all of your transaction.
So, in your professional opinion, um, because we saw such low interest rates, do you think people are so hitched to that now because, it was a great interest rate? It basically, it made things more affordable or gave you more purchasing power. And now that's what they're expecting moving forward because it was so low. Why do you think people are so concerned now about interest rate when in reality, interest rate's only a small part of the equation when buying a house?
Most definitely. I would say that media has kind of pushed us towards that being the end all be all almost, right? A lot of people like to talk about, oh, I have this interest rate. Well, you have that interest rate. Did you pay points for it? Did you get it, up front? Did you refi in the right time? There's different times, there's different reasons to have a certain interest rate. But having a higher interest rate is not, again, it's not the end all be all. I think the media has really almost made other people focus on that one aspect, right? Versus what are you willing to afford? What are you comfortable with, right? What monthly payment are you comfortable with coming to every single month having to pay your mortgage? And if it's higher and it involves a higher interest rate and you don't have a problem with that, then you shouldn't, because there will come a time where, one, you've paid down your loan a little bit, so your balance is lower, and also the interest rates will come down probably. And once you see both of those, you can expect your monthly payment to lower as well, right? Now, that's not to say put yourself in an uncomfortable position, because interest rate does have a direct effect on your monthly payment. If interest rates rise, your monthly payment does increase. So don't put yourself in a position that you're uncomfortable, but understand that if you are comfortable with that monthly payment based on a higher interest rate, it shouldn't veer you away from buying a home just because there's a higher interest rate. Know your affordability, know what you're comfortable with per month, and don't be afraid of having a high 5% interest rate. Don't be afraid of having a low 6% interest rate. And come time to refinance, your local lender will likely be reaching out to you in order to refinance you into a lower interest rate in order to help out your monthly payment and put you in a better financial position.
Absolutely. And it's with that, going back to that example where if you were doing no compounding and say at 3% of 500,000, 15,000, as it's building, or 5% of whatever number interest rate you gave, it's, you're growing. And so in 3 years, hypothetically, you're at what, 545. I mean, by the time you turn around and sell, you're making a profit. And that person who's now waiting may have to pay that 545, which then only hurts because now you're paying more instead of, making money off of it, which I think some people, I don't know, can be skittish about. Is all right, well, they're too focus on the present instead of the long-term investment of home ownership, which is, you're building wealth. And even though it's your first home and it's still a very emotional purchase, there's always a positive, especially in the DC, Maryland, Virginia area. I mean, I don't think there's ever been a time, even during the '08 recession, again, it might be a little bit of a fluctuation, but it wasn't so detrimental like we saw in some places, or even places now that we're seeing where cities like in like Boise, Idaho, are now feeling the effects of the cooling market because they're not getting those high prices that they were seeing last year, where we've still had some consistency. We've always had consistency throughout, year over year, where prices are growing at a steady rate. And it's, again, I feel like this is one of the best areas that you can buy in, even though on some different surveys and all that they don't say so, but I think so, because we have the federal government, federal contractors. Tech is now coming out here. I mean, we have Facebook, Microsoft, Google, Amazon. Boeing is now moving out here. I mean, there's so much opportunity and so much development that's constantly going on. I mean, there's a great opportunity, even with a 6% interest rate. Even if we went up higher, you still have a great shot of buying a piece of property that will always sell at the end of the day.
100%. Yeah, and just to circle back on what you were hitting on originally, I'll give some very generalized numbers, but based off a $500,000 home, again, we're roughly around that low three, maybe even towards the 4 to 5% appreciation, which is the typical number that we hope for and we look for based on, that's as fast as we need to appreciate. If you were to wait 3 years and your interest rate was over a 1/4% lower, and even after those 3 years, you'd probably see a payment difference of around $100 roughly. And to factor in amortization, to factor in appreciation as well, you'd probably losing out on roughly, again, these are generalized numbers, $70,000,
Wow.
right? In your appreciation and in your amortization of money that you've gotten based off of buying that home earlier, right? So again, timing it can be very tricky, especially in the DC, Maryland, Virginia market, just because we rarely, not never, but rarely do see home price depreciation.
Absolutely. And circling back to recessionary times, what does the data show when in terms of recession to home price appreciation? Is there a hand in hand correlation where when we're in a recession we see home price appreciation, or do they always crash? What sort of data is there for people to understand? Because from what I understand, it seems like real estate's its own economy. No matter what, if there's a recession, we could still be in a great market real estate wise, where people are still buying, investors are still investing, home builders are still building, even though right now home building confidence is lower than it has been in a while. Things are still being bought, things are still moving. We are still seeing that small appreciation.
Yeah, so I'll base it off of one, this is national, right? So if we are talking national, this is not just the DMV area, but nationally over the past 8 recessions that flow back all the way until like the early 60s, I want to say. Out of those 8 recessions, we've seen home prices appreciate 6 out of the 8. One was the 2008, right, which the recession came about because of the housing
Mm-hmm.
market. Again, if we head into a recession within the next couple months in the near future, or if we look back and say that we were in a recession, this wasn't because of the housing market. It had nothing to do with the housing market, right? So the only other example would be the early 90s. We saw depreciation of, I want to say, a little bit over 1%. And again, that's a national average. So given a national average, if you were to look in the DMV area, chances are we didn't see any appreciation or depreciation, excuse me. We might have seen a slowing of appreciation, but typically you're going to see home prices do well. People find homes a very stable asset in order to utilize for growing wealth, and or just to kind of have a place to feel comfortable with, knowing that your money's in a safe spot, right? So that is kind of the gist of what you can see in past recessions. Also, we've had a steady climb since probably around 2012 of home prices. We've seen little dips here and there, But we've seen consistent appreciation over the past almost 10 years now.
So even in recessions, we're still seeing houses grow in appreciation and equity, and people are making hypothetically money by the time they sell. And I mean, don't do interest rates get affected during recessions? Do they go up? Do they usually stay put? Do they try to knock them down so they can pick things up? How does interest rates play into this?
So it can really be almost looked at as cyclical, if you will. Um, Obviously, after the pandemic, we saw interest rates, or during the pandemic, excuse me, we saw interest rates at an all-time low. The reasoning for that is they lower interest rates to spike up the economy, get some movement going, right? Once we start to see that movement, interest rates, then what we saw is we saw inflation increase, right? And from there, it's because people are buying more things, people are going out and spending money, right? Supply and demand. The more that's being bought, the higher the prices that are gonna go. From there, once we saw the high inflation, the Fed's next job is to combat that inflation, right? We don't want 9% inflation. We don't want prices increasing that quickly. It's unstable, right? I want to say that the Fed typically aims for around 2 to 3% in inflation. Um, and from there, what we need to do in order to combat that is increase interest rates, right? Slow the economy a little bit, and that's what we're doing, right? That's the soft landing that the Fed is trying to accomplish as of right now. Now, once we do see that increase, now we've seen 2 negative quarters of GDP. What happens in recessions typically is, again, we see that cycle of, the Fed looks to increase activity once again, right? Now, I think they've been really focused on inflation, which is why the rate hikes have continued. Interest rates have continued to increase, even though we haven't seen too much activity within our economy. But I do want to say that once we do see the economy kind of sitting around for a little bit too long, we can expect that interest rates will need to fall in order for us to get the economy moving once again. Now, that's not to say that interest rates need to go back to the twos. I don't think they need to be back at the twos. I think we could find a nice stable point that's going to keep the economy flowing, keep investment flowing, keep home prices stable, and it's going to keep inflation from spiking up too high. So that's kind of the cyclical way that you can see inflation, interest rates, etc. So we'll have to kind of play it by ear because not every past experience is going to be a perfect example of what happens looking into the future. But again, as I was kind of speaking on earlier, when you do see inflation come down, you see prices come down, and that's a generalized term, prices, right? Stocks sometimes are included in that. If we do see the stock market come down, will the Fed have a reaction and say we need to make sure our stock market is stable? That way people don't freak out. Possibly, right? And that's kind of something that we're just going to have to play by ear until we start seeing the Fed making those movements. But as of right now, the main key is to combat inflation. And the main way to do that is to hike the federal funds rate, which will increase interest rates for the time being. But eventually, we might start to see a good reaction to interest rates when it comes to mortgage interest rates because inflation is starting to come down.
No, that's good to know, and can give some people at least some sigh of relief so that they can, plan. Because again, we're not saying you have to buy. We're saying if you are planning on buying, do it sooner rather than later. If you still need to pay down debt, or you're renting for another year or two, or you plan on moving within a year, buying doesn't make sense. I mean, you'll get in the market when you get in the market. But for those of you who are waiting, or to time it, quote unquote, you might be doing yourself more of a disservice than anything. If recession during that cycle, if there's a recession and interest rates go up and appreciation is still going up, now you're really losing ground on what you can afford, and now the subjective term affordability becomes out of reach, and you might be missing out on something that you could have gotten into because you decided to pull the trigger just a little bit sooner. So that is something that I think people should really take into account when talking to their lender or their agent, or figuring out where they want to live, and buying a place, because investors come in and they'll buy places cash out now, and people are losing to a lot of cash offers. Or we've seen foreclosures have been on the lower end. There haven't been as many foreclosures, which is good because not many people are losing their houses. But one person's loss, it can be another person's gain. As crass as that might sound, it's true. I mean, that's how some people get their foot in the door, because they win it at an auction and they're like, all right, I now have a piece of real estate at a lower price. I may need some TLC, but that's part of the world we live in. So some key points that people should kind of take into consideration.
Yeah, definitely. And just to build off of what you were originally saying when it comes to buying and maybe even buying versus renting, typically um, golden the golden number, if you will, is typically around over 2 years. Around 2.5 years is probably 2 to 2.5 years is probably where you'll see yourself breaking even on the purchase of a home. That includes amortization, that includes the paying down of your home, that includes the costs that you would expect being a little bit lower for renting for your first year or two, and versus the mortgage payment that you would have. But once you see that third year is typically when you're going to start to pop out in the green. So if you are looking to stay in a place for the next 3 years and you are comfortable with buying, you have a stable income, you have assets in order to utilize a down payment, etc., and you feel like you're in a good position to buy, don't veer away from it. It's a really good option. And also, we see rent increases pretty consistently. And one thing to keep in mind, once you're in a mortgage, that is a fixed monthly payment that you have, unless if you have adjustable rate mortgage and it's months or years down the line, excuse me. That's a fixed payment that's going to stay the same. Typically, landlords increase their rent pretty consistently, maybe once a year. Some increase it a little bit quicker. It kind of just depends. But that's just one thing to keep in mind. When you are renting for a significant amount of time, you're losing out on a lot of the amortization and appreciation gain that you could be expecting if you were to buy.
So for people who may not know, you've used the term amortization a couple of times. When you go to a closing, they'll hand you what's called an amortization table. What is amortizing? What does that mean in terms of your home purchase?
Right. So let's say I'll use a 9 year period, which is what I'm looking at right now. And let's say you buy a $500,000 home, you put 20% down for a $400,000 loan amount, right? In the next 9 years, you're going to be making monthly payments that include principal, interest, taxes, insurance, possibly mortgage insurance, and possibly HOA dues. The principal amount that you pay on your mortgage payment is going towards the loan amount, right? So from 400,000 after 9 years, again, this depends on interest rate, et cetera, but you can find yourself paying down that principal amount, and maybe 9 years down the road, you find yourself in the lower $300,000 loan amount. Now, once you have that, you now have more equity in your home, right? So if you bought a $500,000 home and your loan was $400,000 and you've paid down of the principal amount, let's keep it even, $75,000. You now have $175,000 of equity in that home sitting there, right? You've paid down 75 and you also put down $100,000 originally. Now that is without appreciation, right? Just to keep it simple. Let's say your home price stayed the exact same. You're now sitting on $175,000 once you sell. If you were to sell for $500,000, you'd be walking away with $175,000. Versus renting, if you had a $2,000 rent payment, that rent is just going out every single month. It's not paying down anything. It's not going somewhere. In a sense, you can think of your principal payment of your mortgage to be money going into the home into a little bank account, right?
Yeah.
Because you're keeping that money in a sense for the time when you sell. So that's the way you can look at amortization, as basically putting away money into your home.
So wow. So then from that, say your house increases by 25,000. So you're not looking at essentially $200,000 in equity, and 25 of that just being from appreciation from the market.
Right. Yep. And if you were to think about a 3% appreciation on 500,000 a home, maybe you're looking at 45,000, right? And then that number increases, right? So you can see yourself gaining equity. You can see yourself increasing your wealth by owning a home within the time period that you're living in it. Obviously, upkeep and other associated factors go along with it in order to value your home. But that's why home have been looked at as a very good asset to have, a very good asset to hold, and a very good asset to keep.
Wow. So, I mean, there's just so many ways with home ownership, even if it's just one property. to build wealth. And I mean, we won't even have to get into multiple properties because that only builds your net worth and other financial investments from there. But essentially, is key takeaways: can't time the market. You never know what's going to happen. We could shoot back up to 18% next year. We have no idea what's going to happen. We could go back to twos. We don't know. It's the best time to get into a place when looking is now. Waiting, unless, if you don't need to, may not be the best option. And, there's a lot of ways to make money from owning a home. So, uh,
Mm-hmm.
outside of that, is there anything else that you think is that we should know when looking to buy a house? What would you need, or what would you want to tell people who are shaky about buying a place right now?
Yeah, definitely. Talk to your experts, right? Call Nick, call me. We're both named Nick, but call one of us, right? Talk to us about home price appreciation. Talk to us about affordability, right? We're not just going to close a deal because we want to close a deal, right? That's not what we're here for. We're here to help our clients. If my clients aren't in the best financial position to buy, I'm going to, tell them exactly the way their file is set up. I'm going to give them a breakdown of what it's going to be. And based off of home prices, based off of the monthly payment that I show them, if they don't feel comfortable with it, then we're going to try to make them comfortable down the road, right? We're going to game plan it. We're going to make sure that you're putting yourself in a good position, a good financial position, a comfortable financial position, right? So talk to your experts, reach out, ask the questions. There's a lot that comes on the media, but the media is it's a sale place, right? The media is out there in order to get you to click on their link, right? So for them to post a little bit more, I want to look for the right word, for them to post things that are more likely for you to click on, whether they're 100% straight to the facts. Sometimes they don't mind, right? Interest rates at all-time highs is not correct right now. Interest rates used to be up in the teens, right? Are they higher than they were last year? Yes. Are they higher than they've been in a while? Yes. But are they insane? Are they destroying affordability? No. Right? So talk to your experts, ask these questions. We're here to help. We're always available, so reach out. That would be the biggest thing, especially in a market as of right now. Also, find a local lender when you're hoping to get pre-approved, because they're going to give you the rundown. They're going to give you a good understanding of what you're really getting yourself into and making sure that you're putting yourself into a good financial position, right? That's the main thing. You want to know that you're comfortable with the cash to close that you have to come with. You want to make sure you're comfortable with that monthly payment that you have. You want to make sure that you know that you're going to be able to get updates come time if you're looking that thinking I want to refinance down the road to lower my monthly payment. You want to make sure that your loan officer is going to keep you in mind, and come time to refinance, they're going to call you to lower your payment, put you in an even more comfortable financial position. That way you can put money in other places or maybe re-inject it into the home, etc. So talk to your experts, use your experts. Definitely, it's good to do your own research online, but just remember that online, you're going to find what you're looking for,
Oh, absolutely.
right? If you look up lowest interest rates possible, you might find an interest rate in the two, but that's not where interest rates are right now for a 30-year fixed mortgage. That's not where they are, right? So reach out to us, ask us questions. We're here to help.